Welcome to the show as we continue the essential 2026 checklist for first-time home buyers. This is going to be a bonus checklist item because it's tax time. Have you ever wondered what to do when you're filing your taxes to make sure that you look the best when you get ready to do your home loan application? I know a lot of times, whether you're a W-2 and especially for my 1099 employees, they have major questions about this. Fortunately for you, today I have a tax expert who literally wrote the book on all things first-time home buying. He's an incredible resource. I actually found the book, reached out to him, and turns out he's one of those people that helps you when you're doing your taxes as opposed to hindering you. Yeah, one of the big bummers about doing your taxes on your own or doing your taxes with a professional that's just trying to get you the most money on a refund is that sets you up for big disappointment when you're trying to buy a home. Let's get into all this right now.
How to Buy a Home educates, protects, and connects first-time home buyers to qualified vetted realtors in their area. Whether you're looking for DIY information or step-by-step guidance, How to Buy a Home is the #1 resource for first-time home buyers.
Hey, everybody. Welcome in. Man, it's that time of year. Half of you out there freezing. It was 78 degrees here in Southern California. Don't hate. But it's also tax time. So it's time for me to bring in Dan, the tax man around here. Mr. Dan Mullen, how you doing?
Doing wonderful. How are you, David?
I'm all right. Are you getting into the time of the year where you start to get super busy?
Oh yeah, it's tax season. We're full swing, full speed ahead. Here we go. Get those taxes filed on time. Here we go.
For those of you who listened to some of my recent episodes where I talked about how in real estate we call dads at home inspections total deal killers. Over the years, financial advisors and tax advisors have become deal killers for first-time homebuyers as well. I found Dan and his brother and their awesome book, Real Decisions, The Financial Impact of Renting and Owning. And it was like we were brothers from another mother. I feel like we're triplets because they talk about the decisions that you make, understanding that home ownership is going to be the base of what you do. And whether it's from his brother's perspective, which was the financial advisor side, or Dan's perspective, the tax side, we're going to get into how you can do your taxes, what to look for on your taxes, the benefits of home ownership and your taxes, and all things tax. So Dan, I have a lot of people that reach out to me and say, well, buying a home is for those W-2, W-4 employees. I'm self-employed. I own a business. I'm 1099. What tips do you have for those people?
Well, number one, that's not a deal killer necessarily. If you do nothing else, there's a lot of programs out there. They're called bank statement loans. They're even called state of income loans. There's P&L loans. Like there's programs that are out there for self-employment or for self-employed people that don't require your tax returns. They end up being a little more expensive and they usually require a little bit more down. We'll get into those details as we go along in the podcast. But just know that, yeah, it is still possible to buy a home. And there's a couple ways to skin that cat.
All right. One of the things that I see all the time when people are self-employed is that they use the tax code to their benefit and they write off everything, which means their income is low. Explain to us like we're in third grade. If you need to use your tax returns, because you said there were options to do that, what do you want to show on your 1099 versus when you're just trying to save all the money?
Well, your 1099 is going to be different than your 1040. The 1040 is the form you file with the government that says, hey, here's how much money I'm claiming. Here's how much expenses I'm claiming. That's true if you're an LLC. If you're an S Corp, one of my favorite things, you're going to have a corporate tax return too, 1120S. And when you're self-employed, you're a mortgage underwriter and you want to use, one of the better loan programs, a conventional VA, FHA, some kinds of those things. They're going to look at your tax returns. They're going to look at both your corporate income tax return and your 1040 to see, okay, all the money gets flowed down here. Let's see how much money this person is really making. Because if you think about it, when you're a W-2 employee, they do what's called a WVOE. Like they have a verification of income, essentially, where the underwriter calls up your boss and said, okay, is this person still employed and saying what he says he's saying? Is that true? When you're self-employed, you don't have a boss, right? Except for your clients. But anyway, not a boss that is issuing you a W-2 and issuing you pay stubs. That's kind of stuff is all on you. So sometimes they treat me, your CPA, as your employer. And so they're calling me up to say, hey, is this person really making what they say they're making? Like, I don't know, because they're just giving me the info and I'm creating a tax return. How am I supposed to know that? And so what I see happen a lot of times is when you're self-employed and you're hyper aware of your tax situation, at least after your first successful year. Your first year getting off the ground, maybe you made $40,000 in net profits. You had a tax bill. Ooh, it still kind of hurt. But man, the next year you make 120 and you're blindsided because you didn't do any tax planning. You get walloped with those self-employed taxes. It ends up being, more than your income tax too. So I've seen that so many times. And a couple of different key reasons that really hits hard and why self-employed people are extra tax aware. First of all, when you're a W-2 employee, the money is taken out to pay Uncle Sam and to pay your state if you're in one of those states. That's taken out before it gets to your bank account, right? And so when you're self-employed, you have all that money and then you have to turn around and write a check. That hurts a little extra. There's a little extra sting in that. And the second thing I wanted to bring up there too is when you're self-employed, you have both sides of self-employment tax. When you're a W-2 employee, you have one side of that. That's 7.65% of your wages. When you're self-employed, it's 15.3. That doubles. You have to pay both sides of that. And so not only is the money hitting your account before you have to turn around and write a check to the IRS and to your state, but also it's a lot more. It's bigger than if you were just a W-2 employee. So those are the things that make self-employed people extra tax aware for good reason, right? We don't like paying extra money for something where we get the same products.
One of the things that I see is when they get to that hyper aware state, that's, when they get crushed that first year and realize, either they start paying their quarterlies so they can get ahead of the game so they don't get crushed, or they end up talking to their CPA and their CPA is like, let's figure things out. Let's write off this. Let's write off that. Let's lower, how much can be taxed. But when you do that, you're lowering essentially the income that you're showing the government. Well, that income is that thing that, like you said, they're calling you and you're like, I just know what's on the return. Well, if they've got a low income, so they have a low tax that hits them in that year, well, unfortunately, that income is how the bank lenders decide how you're going to get a home loan. And so the reason I bring you in is because you're one of the CPAs, like seriously, your book is right over my shoulder with every episode, you and your brother's book. Because
thank you.
Yes, you guys talk about, which by the way, available on audio right now. So you can go find Real Decisions, the financial impact of renting and owning on audio. Well, I've never done a plug before. I never bring people on to do that. But I read this myself and reached out to them. So when you are a person who is, and you talk to someone like that, I have heard about mortgage professionals asking people to redo last year's tax return. Is there a mathematical way where you could see that would make sense for someone if they were trying to pay a little bit on last year's taxes so you can show more income so that you get the loan approval for a home that you want to buy?
Well, let me back up a little bit. And there's a couple of points baked in there. Number one, I don't love when your loan officer tries to give tax advice when they're not licensed to do so. That's super
Amen.
fun. Second of all, not taxable income is not necessarily the same thing as mortgage qualifying income. I had a client who had $13 of taxable income qualify for a $600,000 conventional loan. Because if you know things about add backs, and there's things that can essentially make you look poor to the IRS, and I put poor in quotes because we're not lying to anybody, poor to the IRS and rich to a bank. Now, there's about 12 to 15 levers I can pull on your tax return, and I can't pull every lever for every one. There's certainly limits to this. But for example, depreciation, we'll go in depth about that one because that's probably the most powerful weapon in the holster. But it's possible to have your cake and eat it too with certain kinds of clients, tax clients. And that's one of my favorite consultations I do is I ask them up front too in my interview questions on the organizer, we call it. when we ask you, hey, look out for this form and this form, here's some questions. Did you get married? Did you get divorced? Did you have a kid? One of my questions in there is, in the next 2 years, are you going to do anything with real estate, AKA buy, sell, refinance, remodel, invest in real estate? Because if you're doing that, I'm going to put my different lenses on when I'm doing your tax return and try to make you look, again, quote, poor to the IRS and rich to a lender. There's ways to do that. Now, sometimes the last lever I pull, because it has the biggest tax effect, is, hey, are you taking personal expenses and trying to write them off in your business? I know so many business owners do. And by the way, I'm not a cop. I'm not telling on you to anybody. I'm not telling the IRS. On my blacklist at the top, we've got the IRS, and then there's Satan, and then there's mortgage underwriters, right? But I'm going to, as much as I can, give you the best shot at qualifying for a low rate interest rate, a conventional loan over a bank statement loan, if possible. Now, if your bank statements, if your tax returns show you only have $50,000 in revenue, like there's not a lot I can do there. It's hard to buy a house with $50,000 in revenue, at least in our markets, David. But it is possible to have your cake and eat it too. And so we can go over some of those particular levers that I pull if you like, depending on what you think your audience wants to hear, David.
You know what? I want to back up just a touch, because there were things in there that you said that made me go, okay. So the big thing that I think a lot of people need to understand is they go, well, I'm not gonna get a CPA until I get a house. That happens. I hear that all the time. If you are self-employed, if you are not what we call A+ on paper, if you're not a simple W-2 employee that doesn't have any other investments or anything strange, and it's just crystal clear and it's been that way for 5 years, maybe you can call a CPA the year before you buy. But if you're self-employed, absolutely recommend spending, the hundreds of dollars on a CPA to file your taxes for 2 years, so that while you're filing your taxes with the CPA, you're also working with a unicorn team. You're also working on your savings. And then you're going to find out, oh my gosh, I could buy a home in a year, not 2 years. Trust me, I have the data on this. So you're going to want to have that 1 year of your taxes set up the right way. Now, what you talked about, I'm thinking of all my creative friends, like my freelance people in the performing arts who work one gig and then they work another and then they work another. These are the people that need to, as you said, look poor. How did you phrase that?
Look poor to the IRS and rich to a bank.
Okay. So typically, this was a new concept when I found you, which I loved. Typically, I see people that they show that they've made $75,000, and that plus maybe their partner's income sets them up to buy a home. But because they're a performer and it's all freelance work, they made $75,000, but they wrote it off down to so they only their net was only 25. Now you're saying there's a better way to do that, and you had some lined up. Go for it.
So the example I use very commonly, it's legal, of course. Doing anything illegal is never on the table for me. Like, I've got too many licenses at stake. And it's more correct too. So the example I like to use in this is, let's say you buy $2,400 worth of computer equipment in that year. And you use it for business. Maybe you're doing podcasting. I don't know. Anyone here do that, David? Let's say you buy some computer equipment and it costs you $2,400. Option one, which is legal, is you write off the $2,400 as an expense. There's a law or an IRS rule that says if it's under $2,500 and you're buying an asset, you can write it off as if it is an expense. Okay. But you don't have to do that. You can record it as an asset and instead depreciate it all in 1 year. And because the One Big Beautiful Bill exists, and because Section 179 exists, I promise that's as deep as I'll go in the tax code for you. You can have your cake and eat it too. So if you do it the expense method, that $2,400 laptop, divide that by 12, that lowers your mortgage qualifying income by $200 a month. Can that make a difference in qualifying, David?
Yes, absolutely.
It can. I mean, some of those, qualifying margins are razor thin. But if instead you record it as an asset because it is. It's going to last longer than 1 year. You're not going to consume it. It's not like a ream of paper or, meals that you're going to consume. This is an asset. Record it as an asset and instead depreciate it all in 1 year. Fully legal, again, with the one big beautiful bill or Section 179. Record it as an asset and depreciate the whole thing in 1 year. Your tax effect is exactly the same as if you expensed it. So if you record it as an asset and depreciate the whole thing, you still get $2,400 lower taxable income. If you expense it, you also get lower taxable income, but your mortgage qualifying income goes down too. So there's a better way to do that, all fully legally. That's one example.
That makes perfect sense. No, that's a great example, because I think what happens is a lot of times when self-employed people, when they might take the profits from 1 year and the next year they might buy something big. If they're a food truck, they might buy, some major equipment for the truck, or they might buy restaurant equipment. Or me, there was a year that Apple Store loved me when I spent and bought all my stuff and the fancy microphone. But when you record that as an expense, that lowers what the mortgage bank sees as how much money you made, because you're taking it right off your income. So that is an incredible method. And it is really important for people to understand, lowering by $200, right now it's about $700 per $100,000 borrowed. So that means if you're getting $200 off, you're taking tens of thousands of dollars off of your ability to be approved for a certain loan. And when you're out looking at houses, sometimes you're looking at, townhomes and condos at $350, and the $375 are way better than the $350. So it's a huge difference for people.
100%.
I'm so curious on that, but I want to get into a benefit, and then maybe we can jump back to this. Because you mentioned the big beautiful bill, and we're always keeping up with the tax code. Let's talk about the tax benefits of home ownership versus renting. I know that a lot of people right now, the mortgage interest tax deduction is something that they're not calculating when they're thinking about the affordability of a house. Give us the breakdown.
So there's a couple of tax things that are possible when you are a homeowner, just a standard homeowner and not an investor, right? There's potentially, and I'll talk about the word potentially after I go through these, the mortgage interest deduction, property taxes, and potentially also your private mortgage insurance, although that's a little more narrow. Now, before we get in, why I'm saying the word potentially is there's this thing called itemization. Now, when you file your taxes as a single person or a married person, you can have these what are called itemized deductions, and mortgage interest and property taxes and mortgage insurance. Those are considered itemized deductions. There's a few more in those, but those are the ones that are relevant to this conversation today. So there's those three. If those three do not eclipse, do not total more than the standard deduction, then you will not get a tax benefit at all. Because you want to take the standard deduction, you want to optimize your tax situation, right? So what I mean by that too, let's say if you're going to pay $20,000 in mortgage interest and $5,000 in property taxes, I don't know what state I'm quoting here. I don't know. We're just throwing numbers out. That's $25,000 of, potentially itemizable deductions there. Now, if you're married filing jointly in 2026, it's like $31,000 is the hurdle that you have to clear. You have $25,000 in these expenses, these itemizable expenses versus $31,000. You're going to take the standard deduction. Having that mortgage and property taxes is not going to benefit you from a tax perspective. Now, that same person, if that person was single and buying that home, the threshold for a single person is something like $15,000. So if you're spending the total of $25,000 on interest and property taxes, you're going to itemize. That becomes a tax benefit because you're single, because the difference is in married versus single and that itemization threshold. Does that follow?
Absolutely. So let's speak to one of my fastest growing audiences, single women. We have so many interviews with single women that have purchased, including some single moms. That $15,000 that you said, so breaking it down from the real estate side of things, Either you're going to file your taxes and just take the standard tax deduction. Is that the right term, Dan?
Yeah, the standard deduction, yes.
And that standard deduction would be $15,000. As a renter, that's what you could do. The next year as a homeowner, because the loan, they pad and they put all the interest and they've put it at the front of the loan. So your $2,500 payment might be $2,000 in interest and $500 in principal. So when you're hitting the end of the year there, if that was the case, that's $24,000 you've paid in interest plus that $5,000 in taxes. Well, that's $29,000. So if you're a single person, you got the standard for 15. If you've got 29,000, you need to talk to the right CPA who understands how to help you. And then you're going to get, now that doesn't mean that they're getting, 15 to 29. They're not getting $14,000 dollar for dollar.
Right. It just lowers their taxable income by that amount.
So you're going to be on the standard deduction, you lower your taxable income by 15. Now you're lowering your taxable income by 29, which is a savings in the hundreds, possibly thousands for these guys.
Yeah, it could be. Yeah. And if we just do, let's see, 29,000 or let's make it 30,000 just for easy math sakes. And they're in the 22% bracket there, that might be like, that might be close to $44,000-ish, $4,400 in tax savings right there. So, I mean, I think I know where you're going with this. If you know you're going to get that in the future, you can change your W-4. So your paychecks get a little bit bigger. So you have a little more weapons to pay that mortgage bill when it comes due every month.
I used to have a simple piece before the laws changed. I said, you think you can't buy a home because your paycheck's not big enough? Well, buy a home and your paycheck gets bigger. If you're a W-2 employee and you talk to someone like you and you figure out, okay, we're going to get $30,000. That's going to be about $4,000 a year. So we can redo my taxes today. So instead of all those little acronyms taking all the money out of my paycheck, I can get an extra, $333 a month, 4,000 divided by 12. You can get an extra $333 a month in your paycheck by changing your itemized deductions if you're at 0 or 1 or 2 to get that $300.
Changing your W-4, David. Changing your W-4.
Thank you. Changing your W-4. Man, I'm never going to get those right. And I called a 1040 a 1099 earlier. That's why I know just enough to be dangerous. So you're going to change whichever paper is the correct one, your deductions, and then you get an extra $333 a month because you're a homeowner. That's the beauty of the mortgage interest tax deduction. And I'm not going to go back and redo that again because I just talked it to death. But I appreciate you clarifying that. And the simplest thing that I tell people all the time is there are so many first-time home buyers that say, I'm going to just do my taxes this year, and then when I buy a house, then I have to get a tax guy. Nope. You have to get a tax guy, a tax person, a tax individual the year before you buy, if not 2, as Dan the Man recommends. A lot of people are trying to save as much as they can to buy a home. How do second incomes, side hustles, and all that stuff, what's the best way tax-wise to claim that stuff so that you can get yourself a better loan approval?
That kind of goes back a little bit to the thing I mentioned about recording assets versus expenses is a thing like that. Now, when we talk about things like you're making enough money in your side hustle or your self-employment or your freelance gig, if you're making a little more than $50,000, and that's not a hard number, it depends on your state sometimes, $50,000, we start talking about S-corps. I mean, that's a tax move. However, that also comes into play because there's strategy behind that. Because if you have been in business for like 7 years and all of a sudden you file as an S-corp, and then for whatever reason that year has a downturn in income, like that could hurt you on a mortgage qualifying. So there's a lot of strategy involved. I mean, really, it is talk to either a team of loan officer and CPA who are friends and kind of understand this stuff. You get both with me, of course. That understands the relationship between tax returns and loan qualifying. And you'll find that it has to be really a unicorn because not a lot of loan officers love getting self-employed people, clients, because they're gnarly, man. They they have to get through tax returns. They have to understand a little bit of tax law. There's a lot that goes into those. I know a lot of loan officers like, I don't want to deal with self-employed people at all because they're just too hairy. So, just get somebody with guidance when you make those kinds of big moves who understand the relationship between mortgage qualifying and CPA. And that might be your favorite unicorn lender. And then, your favorite unicorn CPA just working together, get them talking, get them in the same room, get them on the phone call to be able to understand how all of this works together, because the loan officer is going to know loan stuff. The CPA is going to know CPA stuff, what's legal on that side. Get them in the same conversation, before you get filed, because after you file, if you ask me, hey, Dan, I need you to amend a tax return so I can look better on a loan application, that's kind of scary. It is possible. I have to have a really dang good reason to amend a return that is not related to mortgage qualification. Because if I'm doing that, I'm trying to game the system. Like if I'm trying to lie to either the IRS or to your lender, that's three-letter agency territory. So the second part of that too is if I file an amendment and it's justified, cool, sometimes that happens. It might take quite a few weeks to process. So if you're under contract, but your loan's being held up because your tax returns say something different than you want them to say, it could take, 6 to 9 weeks, even if you e-file that tax return, to get to the IRS and to have it processed. So when your lender pulls a transcript of your tax returns, like they need to do that independently. They can't rely on you very much. Like there's a couple of weird loopholes in there, but generally speaking, they're going to try to pull a transcript again. And if it takes 6 to 9 weeks for that transcript to be processed by the IRS, which is hamstrung by the way, because they're underfunded.
Yeah.
That can explode your deal. Your earnest money might be gone because of that.
The fact that you're speaking my language is the reason why you're the only tax consultant that I brought on here. And it's very important for everybody. I think, what I hear from you is people reach out to me all the time and say, okay, I'm like a year or two away. What do I need to do? Honestly, if you're self-employed, just like you're going to start budgeting and saving for a down payment and closing costs as a non-negotiable, you have to do that. You have to work with a real estate friendly CPA early. And, Dan has graciously said that he's willing to do it. He's talked to some of our folks already. But I cannot recommend when people go, okay, what do I need to do for the next year? If you're self-employed, you got to talk to a CPA. It's just a matter of rearranging things so that it looks right for the bank. It's the same thing with your credit score. There's tons of tips and things to do out there, but until you talk to a team that understands what the mortgage banks are looking for, then it doesn't matter because you've got 28 different credit scores, just like you've got, I'm sure, 28 different ways you could file your taxes. And then jumping back. So what I'm hearing is if you've got a side hustle, like if you're making, $15,000, $20,000 a year doing Uber or piano lessons or, guitar lessons, something like that, then you're not creeping into S-Corp territory. So for claiming those, is there anything special you want to do on that to show the most income, like you said, to the IRS?
The one in particular that stood out to me is the Uber driver, because the Uber driver is going to have a lot of miles to put on there. Oh. Now, when you have a business vehicle, there's two ways you can record vehicle expenses. There's the actual method where you depreciate the vehicle itself and gas and car washes and repairs and maintenance and blinker fluid, all that, right? You write all those things off. And then there's the other way, which is the mileage method. Now, that one is preferred, especially if you're driving Uber, you're probably driving a somewhat reliable car that gets pretty good gas mileage. That's better for your business model, right? Just for your overall income. Mileage is going to be your best friend. When you put the vehicle in the business is the time you can decide, am I going to write things off with the expense method, meaning depreciation and gas and repairs and all that, or the mileage method? Because you can't go back and forth year to year. That's against the IRS tax code. I want you to choose mileage because the mileage is still pretty powerful. In 2026, for example, you get 72.5 cents per mile, which is pretty powerful. So if you're driving 10,000 miles, business miles, you have lower taxable income by $77,250. That's pretty sharp. That's a pretty decent deduction. And the bonus of that one is mileage doesn't count on a mortgage application as an expense. So that's one of the other things I talk about for dang sure when I have self-employed people is, hey, did you buy a new car for your business last year? How are we going to record those expenses? There's a play too if you have a 6,000 pound car to where you get a big giant depreciation deduction up front. That can kind of work for you too. Depending on the price of the vehicle, that makes more sense than the mileage method. But if you're already in it,
I know a lot of realtors. I'm sorry to interrupt. I was just going to say, I know a lot of realtors who bought a big ass car they don't need for that stupid deduction.
Yep, that 6,000 pound deduction. I spend quite a bit of time in my CE classes teaching realtors about that thing and why the mileage method might work more if you're trying to buy your own product, realtors.
Well, okay, so when we were talking about these self-employed people, now I want to make sure, like you W-2, W-4 people, whichever number is the right one, you guys haven't been one my entire life. So there were only a couple jobs when I got paychecks with stuff taken out of them. But the mortgages tax deduction is something that you should be focusing on and thinking on. For the self-employed people, as we keep talking, Dan, you said earlier you've got a dozen or more levers, and we just keep kind of bringing them up. All the different ways, whether it's with your first job or your side hustle job. So I've kind of said it, but what's your biggest recommendation to someone who is paying the average rent right now? I think it's $2,200, and they're thinking about buying a home. And especially if they're self-employed, what's your best advice to them?
Well, stay organized. I mean, that's general advice for everybody and every client everywhere. When you're self-employed, get and stay organized. Do you know how much money you're making? It's kind of hard to say when, hey, this month I did a bunch of Uber rides or drives if you're on that side of things. And I had some expense, but I also bought this. I had a $3,000 repair on this. Like, stay organized. If you don't know where you are, it's going to be hard to know how to get where you want to be. So get and stay organized, and meaning like start keeping good books. And if you're confused by QuickBooks, I mean, there's all kinds of alternatives out there. I don't think Uber drivers and I don't think realtors need things like QuickBooks, for example. Like a good, powerful spreadsheet will work, kind of thing. But get and stay organized. Track your income, track your expenses. Because if I'm preparing your tax return, so many times I have self-employed people who, hey, I'm going to do all my books last year right now, right before I have to file. And man, that receipt from January of 2025, I have no idea what that says. My gosh, or that bank statement line, because if they're even keeping receipts. So get and stay organized. I mean, that's going to help you in your business, number one, but it's also going to help you understand, hey, where am I going to sit tax-wise? And if you're organized too, cool. I have, I can recognize that, hey, I bought a bunch of office equipment. I bought a laptop. I bought a microphone. I bought some assets in there. If you're not keeping track of those, then how are you going to know if you can split that switch or not? So really get and stay organized is by far my biggest point for everybody when we get started.
Make sure that when you're talking to a CPA or a financial advisor, that they understand the current economy and they understand the rent cycle, because a lot of times you will go to a CPA and they think when you're a renter that their job is to get you the lowest amount of what you need to pay as possible, which could put a huge damper on you trying to buy a home, because that might show you make way less income than you actually could have shown. And when you're applying for a home loan, if you're using your tax documents, they're going to look at the last 2 years. So some of you are like thinking about buying a home in 6 months, and you should have heard this episode 2 years ago. So for you, jump on it right away and jump to someone like Dan, who is real estate friendly and understands we are now filing your taxes, yes, to make sure that we're fulfilling our government obligation, and yes, that we're following all the laws and legal, and yes, so that, originally the concept is, well, let's make sure that I write off everything I can legally so I don't pay as much. Now there's a different mindset, and that's why you got to talk to someone like Dan. We're going into, last question I'll get you, we're going into, tax filing season. We're recording this on February 2nd, so it's a Monday. They're probably waiting in their mail for their 1099s and W-4s. Is that what they're expecting?
W-2s. W-4 is what you fill out to give the employer.
W4 is
Yeah.
what you fill out. W4 fill out. There, I'm never going to forget it. 4 fill out. That's my alliteration mnemonic device. So is there anything big, anything major changed for filing your 2025 taxes?
Well, there's one big, beautiful bill. There's a few stuff in there, and I don't want to get too heavy in that because I want to keep it focused on home buying. Things like tax on overtime and tips, which were, I think, inappropriately named because it sounds like nobody pays taxes on any amount of tips or overtime, and that's simply not true. But I did want to touch on, I wanted to reemphasize something I think is really important. I wanted to talk about a bank statement loan versus a conventional loan because I ran some numbers on these this morning. Now, when you use your tax returns, when you're shooting for a conventional loan, they're usually better, by the way, in terms of rates and terms. I ran a simulator and I stripped all lender fees away from this. So I just got a pure apples to apples comparison. A bank statement loan that wants, number one, is going to want at least 10% down. Number two, running the exact same scenario was 1.25% higher interest rates than a conventional loan was. So if you're wondering why we doing all this dog and pony show with the tax returns, that's why. I want you to get it way cheaper. I want you to get a better interest rate and better terms. Because a bank statement loan that doesn't use your tax returns is going to cost more. And if that's on a $450,000 loan, that's going to be like a $360 a month higher payment for the exact same loan amounts. So that's why all this dog and pony, that's why we're talking about this, David.
And to clarify, because a lot of those people are coming in and they're hearing about FHA loans and conventional loans. So all of those loans are tax return required loans. A bank statement loan is a non-tax return. So if you're going for that conventional 3% down payment, there's the difference. Number one, 3% versus 10%. Bank statement, you've got to have 10%.
On the best day, you have to have a really squeaky clean credit score. It's probably, 660, I think, is the minimum. And that's going to hurt still for a bank statement loan. Roughly, it's more or less depending on the program. But higher down payment, higher credit score requirement, and higher interest rate, and maybe a point or two, depending on the products.
Yeah, and like you said in your example, $360 a month. That's going to change everybody's spreadsheet. I think that people do. Unfortunately, people do a little bit of research and they'll be like, "Oh, okay." Then they start calling lenders and go, "I want a bank statement loan. I want a bank statement loan." That's great, but if you can't buy a home for a year or so, then for that year, start working with the CPA and start getting your tax returns in order. So what do you do if someone comes to you and says, okay, we got like, about 2% of the down payment and closing costs saved, and we want to buy next year and we're self-employed. Are you going to hustle hard and try to get them one good year on their tax returns? Is that enough, or they're going to need multiple years of tax returns?
That's highly dependent on how old the business is. If they've been in business for at least 5 years, generally speaking, you can get away with 1 year of tax returns. If they've been in business less than 5 years, the lender's probably going to want to see 2 years of tax returns by the time they close, by the way. So if you're at 4.5 years right now and you need a year, like you'll be at 5 years once you apply for a loan. And so they'll probably be able to get away with 1 year of tax returns. But generally speaking, that's why I ask in my setup for my new clients, my new tax clients, is in the next 2 years, are you planning on making any real estate moves? And if so, that might change how I prepare your tax return. I'm going to put my different classes on to do that.
And I think that's the key to the whole reason why I'm bringing you on, besides the fact that I learn everything in all of our conversations, is that just like I tell people all the time, I know that 99% of the internet tells you that just go ahead and call out for a pre-qualification, but that's the wrong first move. The right first move is to talk to a team, starting most of the time with a realtor, and then getting a lender that is locally connected so you have a full team. And then I want people to do that 18 months before they're thinking about buying a home. And people say, I don't want to waste their time. Well, it's obviously not wasting your time if someone has home questions, even if they're 3 years out, because it's right there on your questionnaire That is the difference between a deal-killing dad at a home inspection or a deal-killing CPA who's trying to make sure that you're putting all your money into the stock market, not taking into account that you're paying $3,000 a month in rent for the past 3 years. And that's the deal killer with the CPA, is when you come to them and they go, okay, here's a renter. They want us to write off as much as we can and give them the biggest tax return they can. Because a lot of times renters love that $6,000 tax return to take a vacation. But if you're thinking about buying a home, start early. Dan, these are just amazing tips. I really appreciate it. I know you and I could talk about this forever. I'll put you on the spot. One last word of wisdom to the renters out there that want to buy a home.
Buying a home is the financial foundation of virtually every American out there.
I couldn't have said it better myself. That's the reason why I found Dan. As I said, him and his brother, they wrote the book that sits on my shelf right behind me here. It's Real Decisions, the Financial Impact of Renting and Owning, available in an audiobook. We will put the link in the show notes. I read the book. I reread the book. Hey, nerds, if you think that I'm too goofy and don't give you enough facts and figures and spreadsheets and all that, yeah. Get the book. You will be happy. It definitely satisfies my inner nerd to run the numbers and to realize the earlier you start creating the scenarios, think about it. It doesn't matter if you don't buy a house. The worst thing you've done is gotten more organized and had a professional look at your finances. So thank you, Dan. I appreciate it. And everybody, good luck on your taxes this year. And if you have any questions, go to howtobuyahome.com and you can hit Ask David and check the show notes for Dan's book and his info. We appreciate having you, Dan.
Thanks.
I cannot thank Dan enough for coming on the show and bringing those tips. Man, I'm telling you, between financial advisors, dads at home inspections, and tax pros that are trying to just get people as much money back as they can, these people end up crushing first-time homebuyer dreams. So I'm so glad that you got to hear this the right way with someone who understands how to set you up for success. And we'll make sure we put all of Dan's other stuff. If you want to get the book, we'll put that in the show notes. And if you want to hear him earlier on the podcast, he was on episode 370, breaking down other things about the entire tax filing process for first-time homebuyers. I really hope you take this information to heart, because I have people that work and save on their own after talking to a tax pro that's trying to get them a big rebate. And they come to me 8 months later and they've got everything saved, but they don't show enough income and they don't get approved. So I hope you found this valuable. And if you're new to the podcast, start at episode 400. That's going to give you the first 10 steps. It's the ultimate list for first-time homebuyers. So start there. You can also check out the playbook in episode 440 and 441. And for instant 2026 updates to what's going on in the housing market and how it affects first-time homebuyers, if you haven't already, check out episodes 443 and 444. And thanks so much to Dan again, because, man, this is one of the least talked about things when it comes to buying your first home. Because the real estate industry wants you to do all this stuff on your own and talk to you just when you're 30 days out from buying a home. We understand this process takes a full team working with you months, even years ahead of time. And if this information has been good for you, hey, drop us a review, write a little something. Apple, Spotify, wherever you listen, that's going to help us get the word out to first-time homebuyers everywhere so we can end this paranoia and fear about housing affordability and show people all of their options. Because you know what, gang? You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time homebuyers. So visit howtobuyahome.com to get started.